Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and today is Tuesday, March 17th, and I thought I'd come to you with a brief market update. As we speak, the S&P 500 is up about 5%, right around that 2,500 level that we've been talking about fairly consistently over the past couple of weeks. I feel like that's always very important. I know this is a point that I've made in previous presentations and commentaries, but it's really important when the market gets hyper volatile like this to think about the absolute level in terms of where we are versus any type of up or down metric. When markets start to get super volatile like this and are driven more by emotion and sentiment really than anything else, keeping that firm grip on where we are as a total dollars basis as opposed to an up or down percentage is often very, very helpful. Speaking of that, it's going to bring me to the topic that I'd really like to focus on today, which is the concept of a floor. One of the questions that I get most frequently during times like this is the question of, where's the floor? Where's the bottom? How low can we possibly go? And there's two things that I don't really like about the question, if I'm honest. The first is, obviously everybody wants to know what that particular number is. But it's really hard to define what that number might be because we don't know exactly what the situation looks like 3, 4, 5, 6 weeks from now. There's a lot of uncertainty in the market. And people can just as easily concoct a scenario where 3 to 4 weeks from now we're all emerging from quarantine and getting our lives back on the road, as opposed to a scenario where they cancel school for the rest of the year and we're really talking about July or August before we're all starting to emerge from our holes. And basically those outcomes have very different implications for overall GDP growth or economic growth. And depending on which path we go on will depend on where eventually the S&P 500 sort of settles. The other thing that I think is important to notice is that we are in a sentiment-driven market right now. If you think about the market moving up 10% one day, down 10% another, on relatively low volumes, those are sentiment-driven moves. They're not moves that are driven by any type of rational economic analysis attached to a particular valuation metric. It's kind of silly to think that the collective weighing machine that is or the voting machine in the short term that is the U.S. market would vote that the market's worth 10% more one day, 12% less the next, 5% more the next, based on any type of news flow. It really is a sentiment-driven indicator. And that brings me to my second critique of the concept of, where's the floor and what's that definable number? It really speaks to a mindset of trying to buy in at that floor, right? Let me sell out my positions now, let me move to cash, and let me be able to buy in at that lower level downset and make a pile of money in the process. And that's really goes against the sort of principles of, the principles of market timing that I at least really support and try and, teach you guys and share with you guys. It's not really possible to time exactly where that floor might be, and trying to do so puts yourself at risk because you've got to be right on the entry point and right on the exit point. I heard a CNBC commentator the other day say that the floor for the S&P 500 really should be around 1,700 points because that was the bottom of the market in the 2008 crash. And if you think about that as the logic for where somebody might try and justify where a floor might be or where it might not be, you'd quickly see that people pretty quickly try and define steps or rational points that aren't necessarily there. So in any event, I'm not going to try and define where the floor is. I will give you the advice that we've been continuously giving you, which is, rebalance, think about taxes, take advantage of, the opportunities that this is presenting in your portfolios. And then I'll give you another little piece of advice, which is going to be away from the markets, but, try and enjoy the time. It's really easy when markets are up and down and when things are scary outside to be focused on the news flow, turning on CNN or CNBC and thinking about, where the next new case is, et cetera. And there's a lot of breaking news and it's really easy to get wrapped up in it. But in a weird way, I would say that we've all been given a little bit of a gift in terms of a couple of weeks with our families, a couple of weeks with loved ones. And yeah, we may be a little cooped up and yeah, I'm pretty sure my wife is ready to get me out of the house. But at the same time, to do the best that you can, you just enjoy the time. Your financial advisors are working very, very hard on your behalf to make sure that your portfolios are well taken care of. As always, if you have any questions, please feel free to reach out to me or to your advisor, and I hope you have a great rest of the week.